Hey, Bill Burnett again. Just want to give you an update. The market's real wacky, so hope I'm not boring everybody with these frequent videos. But I just want to kind of update everybody. Uh, Again, last video we were at 3.25. Then we had the market selling off mortgage-backed securities because the banks ran short on their requirements for capital reserves. And then we saw a great sign. This is called a piercing, bullish piercing pattern, which means it's this day, which was a Friday, started out below the previous big downturn with a big candle, and it finished within the body. That's called a piercing bullish pattern. And so that's usually a sign of a reversal. Now on Sunday we got helped out a little bit because the Fed announced a bunch of packages to um, do a lot of things. The banks were not required to have capital reserves anymore. They announced they were going to be purchasing mortgage-backed securities, and the next day was kind of a neutral day. Just Tuesday. This was Monday, Tuesday. Wednesday was just a heck of a crazy day. Thursday and Friday were just out of control. I mean, that's a 300-point swing. And looking at the swing from top to bottom on both of these days, from the bottom all the way to the top, think about that in a day. These were considered a giant move right here. That green box right there is a big move for a day. Look at this. It's crazy. Um, and so normally, in the past, for many years, when stocks, behave badly, the bond market is usually a safe haven, and bonds go up, the prices of the bonds, and the yields or the rates go down. But that's been broken of late, and the stock market's dive lower has, resulted in a lot of margin calls. What that means is when you hear the term locking in an interest rate, the lender locks in a rate for a period of time, 30 days, 45 days, some period of time. And what they do is they short the market. You probably saw that movie years and years ago after the 2008 crisis called The Big Short. So they're shorting it in case rates, dive down and get worse, you know, um, and now you can't provide that rate. So as they move forward during the process, the insurer who says, "Oh, you shorted," and you were betting that mortgage-backed securities were going to drop and protecting you on the upside, all of a sudden you see this happen. Wow, 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 wow. Okay, so what's happening now is the people that are providing the insurance are saying, "Hey, you're way upside down. You were betting that things were going to go down. Look how much they've gone up. We're not waiting until your loan closes and that lock expires. We want our money now." So, eventually lenders will make their money when the loan closes, if it closes. But in the meantime, the insurers are saying, "Hey, send me the money now." It's called a margin call. And so that's what's happening as the Fed, does its crazy stuff. And I'm not a big fan of the Fed. Uh, you know, that causes a problem. We'll talk about that in a second. And then, of course, you have people like Steve Mnuchin, the Treasury Secretary, saying that if some of these measures aren't taken care of now, unemployment could go to 20%. What? So obviously the market took that. Oh, well, mortgages be paid. We're going to have delinquencies or foreclosures. So now you're getting an additional layer of risk built into loans, which is keeping the rates up where they are still. We're seeing some movement down in the mid threes, 3.6, 3.75. 3.65 right now is the best rate that I've found on the market. A lot of places that's with points, and there's still some people's up in the fours, believe it or not. They just are still dealing with the capacity. So we have to shed the volume, get rid of the capacity first. Nothing's going to happen until that happens. And then we have to work through these other problems. So when you look here, this was Monday, Tuesday, Wednesday, Thursday, Friday. All 5 of these days this week, the Federal Reserve stepped in and bought $50 billion of mortgage-backed securities every day. So that drove the price up because they're sucking up all the supply in the markets. And of course, that's causing the margin calls, which is actually having a negative effect on the mortgage industry. So instead of what they think is going to happen, a good thing, they're actually causing a bad thing. Yep, the Fed's at it again. But just to kind of show you, if everything was all even today and lenders had normal volume and everything was running smoothly, the move from right about here, we were sitting on, February 26th at 101.08, so let's call it 101. And the ride up to 3.25, which is 102.63. So let's call it 150 basis points. All right. This was 3.375, 3 3/8. This was 3.25, an eighth better. Now looking at where we are right now, 102.53. We're closing today at, or we did close today at 104.44, up 75 basis points, which is ridiculous. To go another eighth, 150 basis points, we need to go to 103.5, so call it 104. All right. There's 104 right there. All right. Here's where we are right now at the close. So we've gone way past 104. And again, if that's an eighth of a percent, then this theoretically should be an eighth of a percent at least, if not more, maybe even a quarter. So we should be at like 3 and an eighth or 3% right now if market conditions were all the same. So once we get rid of this volume, the capacity, again, I mentioned in the last video, last year we did a record $2 trillion of mortgage transactions in the industry. In the last 30 days, we've gotten 3 trillion in the pipeline in 30 days. So that'll give you an idea on what's going on with the volume. When I say we're beyond capacity, it's way beyond capacity. But if everything starts to shed off, the volume, will be good. Now, the latest thing is today, lots of jumbo products are gone. You can't get a jumbo loan. So anything above 765 is just almost non-existent. Some of the outside of the box programs are disappearing as well. So risk is, these investors on Wall Street and different places are getting very nervous about things, and I don't blame them. Unemployment's a big consideration here. It's what if I give them a loan and 30 days later they're unemployed? So that's factoring as well. So just want to kind of give you an update, show you the volatility continues. It's crazy. But if you have any questions about the technical side of the market, if you're looking to get a mortgage, if you want to develop a strategy, feel free to reach out to me. If you have any questions, you can drop them in the comment box and or call me as well. Again, Bill Burnett, Homestead Mortgage, 703-598-4198. Hope you're having a great weekend. We'll talk to you very soon.